Good evening, everybody. All right, we have, again, the great pleasure of having Price with us tonight. I'm always very honored to have Price give his presentations here. I've known Price for years, and there is nobody that I respect more than Price Headley with the with technical analysis. Tonight he's going to give us a presentation on how to use the low price options to make some big profits. So, Price, good to have you back again. We're anxious to see your information tonight.
Steve, always a pleasure to be with you and the Candlestick Trading Forum audience. It's so much fun, and we share such a passion, I know Steve and I do, for helping educate you all on things that are working in today's markets. And a strategy that actually I was just telling Steve before we started, I frankly was reluctant to share with the public for a while because basically I didn't want to seem overly hypey about things, but just basically this strategy keeps working. We can buy really cheap options, and yes, that is my real name, Price Headley. I'm actually the third. My family's been in the thoroughbred breeding stock business rather than the stock and options game. In fact, when I was at Duke University, I told my dad I wanted to do something more conservative than breeding thoroughbred horses. I wanted to trade stocks and options. Well, the reality is that the price is right on these low dollar options where you can get really tremendous leverage and have some huge winners. Now, this is definitely my most aggressive strategy I'm going to share with you tonight. So I want to caution you that you can lose what you put into any investment, and there are going to be down cycles. So bottom line is that don't just have stars in your eyes when you see the kind of numbers we've been able to generate over the last 13 months now since the beginning of last year. So with that in mind, let me just quickly share with you just a reminder that everything we're talking about here is for your information and education only. And by the way, my lead consultant, Chris Saracey, is in with us to help answer questions. So thanks, Chris, for taking your time, too. But basically, nothing that we talk about here should be considered a specific recommendation of buy or sell any particular investment. Of course, you know that you are 100% responsible for your own investment decisions. Big Trends and his staff are not responsible for any trades you choose to make. And not all trades are appropriate for, and all products are appropriate for all types of traders. Let's face it, what I just said before, what I'm going to share with you tonight is not for CD money, widows and orphans. It's for the aggressive growth kicker in your portfolio, if you can handle it. Some people can't handle the potential, not just for upside volatility, but downside volatility. And I'll show you how we've done managing that through the last 13 months since we started doing this Grand Slam option strategy. At Big Trends, we don't provide personalized financial tax or legal advice to any one individual. What we do is we send out our research through real-time email updates and text alerts now to your smartphone. You then decide how you want to use it. And make sure you check with your tax advisor now more than ever with the new tax laws to make sure you know how any investment might impact your unique tax situation. So what are we going to talk about tonight? Options at $1 or less. What that means is that every option contract typically controls 100 shares of stock. So when I say $1, the way they're quoted, that means that you pay $100 or less to control 100 shares of stock. So they're priced and quoted at $1, but that means it would cost you $100 to control 100 shares. Obviously, there's tremendous leverage when you're only paying $100 for something that 100 shares might be anywhere from $4,000 to $10,000 or more that you're leveraging for just a tiny fraction of that stock's cost. We're going to talk about the concept of gamma and why, if you're an options buyer in particular, even if you're an options seller, really should be aware of the impact of quick gamma surges and how that can affect your premiums, in this case for the good when you're catching a multi-point move in your favor. We're going to talk about our Grand Slam options alert service, including the filters that I like to use, the CCI, the Commodity Channel Index, what I call my Big Trends bands, which is a modification on Larry Williams' %R in a different way you can visualize that to see the real big breakouts. And then ADX, the Average Directional Movement Indicator, when all those three legs of the stool have to be in place in order for me to make one of these trades. 2 out of 3 is not acceptable. All 3 have to set up properly. And so we'll walk you through a number of case studies. Now, this chart, as I told you, it's gone parabolic. That doesn't mean it's going to keep going parabolic. It could keep going up, it could go down, or it could flatten out. I'm not predicting what's going to happen in the future, although I do have a lot of confidence having traded this now. I'm in my 28th year of trading. As I said at the beginning, I graduated from Duke University, then I went right into trading, thought I was a genius with all my great analysis, and was very stubborn and made some big mistakes early in my trading career because I thought I knew more than the market. I quickly adapted after some early pain to realize that, you know what, I've got to go where the market is going. I've got to follow the trend. Thus, when I launched my company, Big Trends in '99, we always are about following the trend. Don't fight it, follow it. It's a lot easier to reach your destination flowing with the river than trying to swim upstream. You can see the last year, now 13 months through the end of the day yesterday, is in the books, actually through today, 2/1, we did this update for you right at the close. Taking a $10,000 portfolio, putting no more than $1,000 into any one trade, and never holding more than 5 trades open at once, up $27,500 in gross profits. When you add up all the gains and losses before commissions. So what this means is that take your own commission costs that you would do on $1,000 per option trade, and know that we might do maybe 100 trades in a year if, in that neighborhood. Maybe about 8 trades a month, sometimes 6 trades a month, but we're trying to average about 8 trades a month or 100 trades a year. So take that out, and you're still left with that awful lot of upside. We'll go through some more of those, breaking those down in more detail, but just as an example of what I like to do, it doesn't always work, but basically when it does, one of the benefits you get when you buy options, see, a lot of people, by the way, how many of you have actually traded options before? And if you have, tell me how many years of trading experience you have. Just type a number like 1 year, 0 years if you're brand new, 10 years if you're, or 30 years, or whatever your number is, just to get a sense of how many years we've had people trading options. So we've got a 25, I see a couple 10s, I see a 30 from Mark, I see a 0, there's some that have never traded. Don't panic. We'll teach you about how you can learn this. So we've got a wide range of experience, but quite a few that have had 10 and 20 plus years of experience, as well as quite a few that are in their first year of learning about this stuff. So cover the gamut. That's great. I love that because you're going to get a taste of this whether you're new or very experienced in options. A lot of people, like Nate mentions, have been afraid of options. In fact, some people have gone into options, what I call they plunge in without any education from Steve, myself, or anybody else, and then they make mistakes and they go, "Oh, that's a terrible game buying options. I'll never do that again." And then it's basically ignorance that gets people out because they don't realize when they should be buying options versus when they should be staying on the sidelines, or when it was more of a selling options market. We have strategies for every type of options trader, buy, sell, or a hybrid of spread trades in between. But the point here is that we're in a very unique opportunity. Volatility is very low. I think I've got a volatility chart in a minute, and you're getting a lot bigger moves than what the volatility is pricing these options for. So with Microsoft, I was able, when the stock was trading, this is back in October, for example. We'll show you a number of different examples here in recent months. But I was able, when the stock was trading here in the neighborhood of about $75.50. I'm sorry, call it $76.50. It was $76.42, I remember, off of that open. That we bought in mid-October, October the 12th, we bought a Microsoft November 80 strike call. What that means is we were buying a call, a right to buy Microsoft at $80. And you're saying, why are you buying a right to buy at $80 when it's still not, it's 3.5 points away from underneath $80? Because you pay very little for that. We paid 55 cents or $55 to control 100 shares of Microsoft, trading for us about $7,600. So that's more than 100 to 1 leverage. You can see here as it kind of ground up a little bit over the next week, and then on the 6th day we hit our double right here in this first square. Double in the first half. My first rule for you tonight is I don't care what investment you trade, whether you trade the Grand Slam out-of-the-money options approach, whether you trade Bitcoin, whether you trade big, fast-moving stocks, or even long-term stocks like Apple. If you double your money in any of those vehicles, my rule of thumb on any of my investments is take half of my position off at a double. And you say, hold on, you're going to pay taxes on that. And I say, yes, gladly, unless it's in an IRA account, which you can do options in IRAs where you don't have to pay the taxes till you retire. But the bottom line is that, with certain brokers, by the way, not every broker in an IRA, but bottom line is that, you know, what you're looking at is you have now created a free trade if you take half of your trade off at a double. When Microsoft had earnings due a week later, and it's kind of, you can see the stock kind of stalled out here. We're going to go into all these indicators, so don't panic about what's happening below. But essentially, we're outside of my big trends band in light blue, and I'm saying, look, we have not hit our next target at plus 200%, and I'm going to say hold the trade into the earnings. I don't always do that. I cashed out of Starbucks early, the day right before they reported earnings, booked a 50% gain, was glad I did because the stock tanked back down. Today, I was holding half of a position in Alibaba. You saw Alibaba probably today. What did it do? Well, I was in calls. I sold half at a double, and the stock tanked down 12 points initially. We told people not to panic. We got out of the rest and averaged a 25% gain on the whole position. So the bottom line, and Joe says, are options as dangerous as shorting? Absolutely not. So the beauty of buying these options is you can never lose more than you put into these options. You can make many multiples. In fact, the rest of the story on Microsoft is the big gap up where you see here late October where it gapped up about 5.5 points. Those 80 calls that were out of the money by about a point or point and change before the earnings hit, the stock opened at $84.30. Now, if you're new to options, you may not understand this, but most of you know that if it's opening at $84.30, what does an 80 call have to be worth intrinsically when it's at 84.3? You have a right to buy at 80. It's now at 84.3. That differential, the 4.3 points, is called intrinsic value. Those options actually open at 471. That's right. Richard was in there first with the right answer. Bottom line is that you have the opportunity here to say we sold at about 471. I think was the average exit right off the open for that 756% gain on our original $55 a contract. Now out at 471 a contract. So think about it. If you did $1,000 into a trade. If it was $50 a contract, I get you 20 contracts. It doesn't matter to me how many contracts I get here, but obviously I'll never buy them over $1, so that $100 a contract. If I'm doing $1,000 as a model portfolio, that means I'll at least get 10 contracts on every trade. In this case, obviously just going from 55 cents to 4.7, that's the 756% profit on that second piece. The two halves average together 428% overall in the whole position. So you can think about it. If you had 10% of your portfolio in something that went up 428%, you're already up 42% of the year on the overall portfolio. Okay, gross before commission, yes. But bottom line is that that's the kind of thing that can make your year on just one trade like that. And we've got a number of those examples to show you. Now, when we break it down on a month-by-month basis, I like to break it down month-by-month here because I don't know about you, but my eye, even though we've been killing it, including the last couple of months, and again, past performance is not a guarantee of the future results. We're going to have down months at some point, but I'm telling all my active subscribers, calm down. They're going crazy with how good December and January have been, our best 2 months back to back of the 13. December was a new high, then January exceeded it. But you can have a month like September. We were 0 for 5 in September. Okay, we took on some trades that did not fire and basically stopped them out. It's possible that one or two can even totally wipe out. I don't know if any did in September, but you get a minus 50 here, a minus 60 there, a minus 30 there. They add up. So what I tell people is you've got to take small bets as a percentage of what you're trading this type of an aggressive methodology with. So if you're trading 10 grand, I always tell people never commit more than 10% a trade, no matter what. Prefer you start with 5% a trade. Something like that. So that way, any one trade is not going to make or break you, but you're looking at it more of as a system over time. So if you hit a rough patch, then basically you're not going to panic. You're going to stick with it. So start small and build is always what I preach with this approach. So again, 2 losing months. November was down just a hair. But hey, you're going to have months like that where the market chops around. You don't get the kind of trend moves that you've seen. But we're doing this on individual stocks. We're not using the ETFs. Harold asked about those. The individual stocks can move much more than an ETF. If you buy the S&P 500, you get a big move in one stock. The other 499 may or may not make that same kind of move. Most likely they won't. You get various offsets, and that's why you've seen this market go through this rotation is a big word where the S&P, the NASDAQ, they've had times where they cool in the last year especially. They don't really give back that much because when tech stocks sell off, money moves into financials or moves into energy or moves into those. Our job in Grand Slam, my job for you to help you is to get you in the next big move. Like we got into Schlumberger at the start of the year this year, right as it took off. SLB, we've got a chart on that later, went to its 300% final target objective in a week. So you catch these quick moves, and we'll talk about why you can get such gains so quickly. Always remind you, though, that you could lose what you put into an investment. Now, you see, as of most of 2017, the VIX, the volatility index, I'm sure you're all aware of, even if you're new to trading, everybody talks about the VIX as the fear gauge. There hasn't been a lot of fear. It's been stuck. It got as low as about into the 7s, I believe. Definitely was hovering around the 8s for a good chunk of late last year. We know that just in the past week it spiked back up to 15. But basically it's been hanging in the low teens, and meanwhile around 10. And this is supposed to be pricing what the S&P 500 should move plus or minus over the next year. So if you see VIX at 10, they're telling you the S&P should move plus or minus 10. What did the S&P do this past year? With dividends? You know, without dividends, I think it was like 22%. With dividends, it's like 25%. So if you're paying for something that you're paying 10% volatility and you actually get 25% total move to the upside, you're getting a 2.5 to 1 bang for your buck on just the index alone. Now, the bang for your buck in individual stocks can be much greater. So, you know, the bottom line is that, you know, you can really see dramatic annualized rates of return very, very quickly with what I'm going to show you here today. Now, when I talk about options home runs and the word home run, I think immediately of one person, and that's Babe Ruth. You know, nobody personifies that kind of swing for the fences mentality more than the Sultan of Swat, as he was called, the Babe. And what I thought was interesting is when you go back and look, he hit 714 career home runs. That was not eclipsed until the 70s. I remember watching with my dad, Hank Aaron hit his 715th out of the park back in the mid-70s, maybe just before the mid-70s. And bottom line is that what's interesting about Babe's record is that, you know what, he had almost twice as many strikeouts as he had home runs. Yet still he was a champion on teams that he actually played for 6 times. He actually was a champion with the Red Sox officially 3 times. So the first year he didn't actually have an at-bat or an appearance. I didn't count that one. But you know what? In his career, that's a tremendous win rate for, you know, that game that obviously most people don't see championships that often as a franchise, much less as an individual. So I love his quotes here. He says, "Never let the fear of striking out get in your way." How many of you, I don't even want to ask, I don't want to put you on the spot with an open kind of Q&A here, but I know a lot of you have basically gotten kind of gun-shy in recent years about taking your profits very quickly because you've been burned before about you had a profit, you thought it could run more, you held on to it, walk in the next day, bam, it's going the other direction, you gave up your profit, you saw a profit turn into a loss. Well, so what that's done is it's made a lot of, I call that, by the way, I call that psychologically, I call that scar tissue. You know, the longer you've been trading, the more of that scar tissue you probably have. You know, and frankly, the only way for me to work through it in 28 years of trading is to have a systematic approach. If I was just going off my gut every morning, I'd be a basket case. I guarantee you, if I was just trading on my gut, I probably wouldn't be talking to you tonight. I'd be doing something else because basically everybody's emotions are prone to swinging you out at the worst possible times, or worse yet, swinging you in right near the peaks before the next drawdown ahead of you, right? So we can't afford to do that. We have to make sure that we take a systematic approach. If our system says you shouldn't be making any Grand Slam trades right now, Warren Buffett's quote's one of the best quotes on that. He said the beauty of the stock market is you can wait for your fat pitch, as he calls it, the pitch where it's like that juicy one that you know you can hit out of the park. You don't have to swing at every ball that's thrown, at every stock, that an option trade that comes around the corner that happens to pop into your head. So the idea here is that if you're disciplining and can just wait for your I just love that quote from Buffett, the fat pitch, and same with the baseball analogy. The principle, by the way, if you're new to baseball, is that that ball looks even bigger, like it's just so easy to hit, like it's just sitting there just waiting for you to hit it out of the park. You know, the ones that are whizzing by you that you kind of like, whoa, what's happening here? I don't feel like I'm ready to hit anything. You're better off not to trade until you get into where you're in that zoned-in, focused approach, and then you can have a much better chance to really knock the cover off. So basically, you know, Babe said he hits big or misses big. I don't really like to miss big. It's going to happen sometimes, but basically we want to minimize that. Now, when we talk about other influential elements in the market, this gorilla kind of scares me when I see that picture, but it's because it's meant to scare you. You should not ignore the 800-pound gorilla in the room when we talk about the investment markets. And who is that gorilla? It's the big institutions. Let's face it, you and me as individuals, whether you're trading $10,000 or $10 million, we're all small monkeys against that big gorilla that basically could cause a bunch of problems, right? So the idea here is that, you know, we could easily be trampled by that big guy, if you're not getting on his back and going where he's going. You don't want to stand in front of him and get trampled. You want to say, let's follow behind, let's ride with him and go to where the next opportunity is. So the big fundamental for me that matters here, the number one fundamental catalyst for me that I always keep in mind for options home runs is earnings surprises. Now I'm gonna highlight the word surprises, not the word earnings so much. You know, we're still in earnings season. You know, you get lots of earnings reports coming out. You know, and basically, you know, you've had a lot of talk recently about Apple and, you know, how Apple's, you know, not hitting it with their iPhone 10, and then what do you know, they come out with earnings today and the stock's up about $5.50 or $6 after hours. You know, so it's all about expectations, and it's about, does the stock actually go up after the earnings or does it drop after the earnings? When it drops after, quote, good news, that's not a positive surprise to me. That, if anything, is a negative surprise if good news can't rally that stock. Better yet, the news is kind of, people aren't so sure about the earnings and the stock rallies. I call that a positive earnings surprise. So what's going to happen is the institutions want more of what works and less of what doesn't, just like you and me. And so the reality is that you have a situation here in which, you know, the prolonged buying, which, think about, what is prolonged buying or prolonged selling known as in technical analysis terms? That's called a trend. Prolonged buying is an uptrend. Prolonged selling, a downtrend. The institutions can't jump in as the 800-pound gorillas into the baby pool all at once and splash all the water out of the pool. Then that's going to be no fun for anybody. They're going to take a lot of pain if they do try to rush in or rush out too quickly. So they're going to ease in. They're going to buy every dip in an uptrend. They're going to sell every bounce in a situation that's got a negative earnings story. Look at retail, like department stores, most of last year until the holidays. They were basically disasters. Every bounce, Macy's and all those were heading down. We were, Bed Bath & Beyond, we were on a bunch of those on the downside in our big trends portfolios. But the bottom line was that, you know, we just saw what the earnings reactions were. We saw what the institutional pressure was. And so every bounce you could sell those. Hard to do in a bull market, but the opportunities are there. Certainly we're going to see more of the big positives in a big bull market, but we'll have bear trades as well. But the big lesson here is never fight an earnings surprise. If you say, oh, I don't know why that stock was down, the earnings were good, well, then you're fighting the earnings. You're setting yourself up for problems. Go with the reaction to the news, not the news itself. Okay, another big one here when we talk about, you know, those earnings surprises leading into what I call fat tails in the this is more statistics-based, so I'm not going to get too hung up on this, but give you just a concept. You know, the guys who created the Black-Scholes options pricing model that allowed options to be publicly traded back in 1973, they won the Nobel Prize for the options pricing model, the Black-Scholes model, back in 1997. Does anybody know where they went after they had all that glory of the Nobel Prize? They went to a big hedge fund. Does anybody know the name of that hedge fund? At least two of those guys did. And the big hedge fund name was, that's right, Philippe's in there first, LTCM, or Long-Term Capital Management. In the day in the late 90s, that was the biggest of the big hedge funds. That was the gorilla, if you will, that was making very leveraged bets, not necessarily just using options, but using what's called swaps. And the one that caused the 98 crash, that's right, Jay, it basically almost took down the financial system, even before the 2008 collapse. At the time, back in 98, Lehman Brothers was already rumored to be insolvent because they had sold out-of-the-money puts to LTCM, long-term capital, and those when the Russians defaulted on the ruble and those emerging markets tanked, and all those bets that they had made that those markets had to bounce back, and instead the trend continued to the downside, those bets were now in the money on the downside, and Lehman was in the hole. The big banks and the Fed had to come to Lehman's and the other companies' rescues together to bail out long-term capital, and bottom line is you definitely have an example of how flawed the options pricing model is, and a key assumption, which is that the options pricing model assumes that we have a normal distribution, meaning that more often than not, when you call the current price, the no deviation from that would be the zero deviation on the left here. It's saying that's happening on the normal distribution assumption about 40% of the time, when in actuality, the more true distribution is more log normal, and that's just over 30% of the time that is staying around the current price. We all know that the 100-year flood's happening a lot more than once every 100 years. A lot of people I talk to are worried about the fact that we had 250% drawdowns in the 2000s, right? In 2000 to early 2002, and again 2000 and off the 2007 peak into early 2009. So when you have 50% drawdowns in the stock market, two of those in 10 years, that less than 10 years, that's definitely more than the 100-year flood, right? In fact, another way to think about this is that the S&P 500, if you took a 3-deviation negative event, that would imply that the S&P in a day drops 3.5% or more. The implication on if it was truly a normal distribution, in 100 years it should only happen 27 times. In reality, it's happened more than 100 times since 1927 in 90 years. So the thought is that you can see it's happening with a fourfold effect. So what happens with these tails, these 2-deviation negative or positive tails, they might be happening, say, 5% on either side, 10% total, versus what's expected is more like a 2.5% on either side, or maybe something more like 5% total. So the tails are about twice as fat or wide as what the market expects. Now, you might say, well, that still sounds like a minority of the time. And that's true. They're not going to happen all the time. But when they go, you've seen these big trends across not just random growth companies, the next Tesla or whatever, but also across Boeing, Caterpillar, a lot of those names last year where they just kept going and going and going. And so you want to get a piece of that. So we're going to talk about the indicators that make this up, because I know I could go on and on all night, and I want to allow Steve and his crew, as well as you all, to get a good night's sleep, be ready to trade tomorrow. But I've got some stuff to get into here on the indicator side. So CCI, the Commodity Channel Index, developed by Donald Lambert, and we're going to get into some charts. Basically, he developed it to look at commodities, but I've definitely shown it to work with a lot of stocks, and I even use CCI in my option charts as well. Bottom line is that the difference in CCI from most moving averages or other indicator calculations, most of those other indicators are using closing-only data. CCI will take the high plus the low plus the close divided by 3 and create what Lambert called a typical price. And so you start to see the weighting when something's closing near the high of the days. It's going to have more of a weighting up, or closing near the lows, a weighting down. And that over time across an average is going to create a sign of how much thrust, how much momentum you have. The big takeaway, if there's one takeaway tonight that you'll probably see across the charts, is that overbought is not a bad thing. When something goes to, quote, a bullish extreme, that sounds like it's a top. It's not. It's actually kind of like something, like, think of it more like a rocket or a space shuttle that takes off. You need to have a lot of force, a lot of power to thrust that thing up off of the ground, off of the gravity. We all know about gravity, right? Both in rockets and in our portfolio probably. But the reality is we want something that's going to go take off and not look back. So how do you do that? You've got to have a tremendous amount of force. That's where all that fuel's being used. All those flames go to propel that thing up. Once it's got enough momentum, those rocket boosters peel off and it coasts on its own momentum, right? If you don't get enough of that, what happens? It crashes back to earth. You see that with a lot of stock trades and option trades you may have made. You thought it was breaking out. It really wasn't that strong. It comes back down. You were hoping for something that just wasn't strong enough. So we want to see that kind of strength, and you'll see the charts in a minute. Oversold on the other side. Guess what? It's all back to institutions. The institutions are dumping those big losers. They're plowing out of those. They're going to keep pounding those. The short sellers and hedge funds are going to keep pressing those downside bets. So the bottom line is that you want to be on the right side of the overall trend. ADX is another tool we use. Wells Wilder developed this. Same guy that developed the RSI indicator to show you trends. A lot of people critique ADX and say, well, it doesn't really show you what direction a trend it is. We look at the positive directional movement, which is the net new highs. The negative directional movement is the net new lows. And the interplay of those. Obviously, if something's making net new highs and no new lows on a day-to-day, week-to-week basis, what's that called? That's an uptrend, right? The channel is up. And you'll see when the trends really get going, ADX will get going from a relatively low level and get turning. We'll show you some examples. And then big trends bands is a new way that I like to say you can see the power trends. Now, Larry Williams, I've had a lot of interaction with him. I think he's truly one of the market wizards. That basically he's created a lot of indicators like his percent range indicator. And, that's shown down here on the bottom. And, that's an overbought, oversold oscillator. Something goes overbought. Most people say, oh, it's at the top of the range, you should sell it. We can see on Baidu, it was just getting ready to launch. And so you see, while it stays red up here where most people say, uh-oh, it's bad, it's overbought, look at what Baidu's doing. It's going straight up. And so what I did is I coded where this light blue line should be showing you where would the retracement be if it stays overbought back to that support line, and if it doesn't break through that, you can basically see some really unusual big trends up or on the downside below that jagged white line here. If it got below there, you could see some big problems on the downside if it showed the proper configuration. So bottom line is that it's not happening. You don't guess on it happening. You wait till it's in progress, just kicking off, and that's where, when all these things are coming together, we're going to get some tremendous opportunities. It's kind of the old 80-20 rule. We look for the top 20% of %R readings. That gives us 80% plus of our results. So you know what the Pareto's principle means. It means that 20% of your actions are going to drive 80% of your results. In life, in business, 20% of your customers are going to drive 80% of your profits. 20% of your customers are going to drive 80% of your problems. The bottom line is that you can use this concept in trading too to say, you know what, it's the same thing in trading. 20% of my trades are probably going to drive 80% of my results. I want to be in those top situations. So here's an example of Baidu last July where you see, okay, there's %R going over bought. I'll just block it where it goes from white to red right here. Okay, we don't buy right there. CCI came on a day later where it was setting up. So those are all having to come together. ADX has to have crossed up. The green line here has to be started to head up. That actually came in a little earlier. So 1 on ADX, 2 on %R when it finally confirmed just behind there, and then 3 on CCI. Those %R and CCIs were both setups, and then we closed above it right there the next day. So we're in there buying the next morning's open right there off of that circle low right in the morning. We're saying that's where we want to get a piece of this. You say, I can guarantee you just about every time when we make a buy recommendation, you're going to say, why didn't you buy a week ago? Because basically we're saying, you know what? We were waiting for what I call the confirmation that this isn't just another fake out, head fake, that it looks like it's going, then it flips back down. It's waiting for that institutional persistence that they've got to be a part of this, and they start plowing into this thing, and you want to be a part of it too. So that's basically the premise here. Now, Lee asked what are the settings on some of the indicators like %R. We give you all that as a subscriber. I'm going to tell you later how you can get a phenomenal entry point because we've had a lot of people that have locked in a year plus of Grand Slam here, especially in the last couple of months of big home runs that we've had. I'm going to give you a chance as part of Steve Bigelow's group to get in and try it for a month and see how you like it. I think you're going to love it. And especially without having to make a huge investment up front, so you can get your portfolio working, start getting those profits. Then you can go into renewal mode on a bigger subscription down the road once we show you what we can do for you. But bottom line is, we'll get to that later. You can see everything's signaling together, and you can say, gee, the last piece, 300% we made on the 4th day. So we take half off at a double, another half of our half or a quarter of our original position at a 200% gain, and the final quarter at 300% gain. You say, well, you guys left money on the table. It kept going. That can happen. I don't care. If you take $1,000 and you say, okay, well, I double it at a double, so then I take my half of that position, my original 1,000 back in my pocket, your risk capital is now safely back in cash, then you can say, okay, now it's a free trade. Now you've got the potential to let the rest of that trade run more effectively. Now, before getting into other charts, let me share with you a little options concept that a lot of people aren't really aware of. Most people know most of these concepts. The first one that a lot of people realize is theta. That's that time decay component. And I'm talking about buying out of the money options. We'll show you a chart in a minute about kind of the sweet spot for me of where I'll give it a chance to go quickly. If it doesn't go, where I'll hop out. Also, Vega, of course, we're in earnings season still. And, of course, if you're buying something like Apple calls or puts right before tonight's earnings, then basically you're paying up for that, and then that volatility is going to come back down tomorrow. So we don't like to play that game. Anything that we trade, we're going to want to buy it at least a week ahead of earnings, so we give ourselves at least the first week to try to get that double under our belt. The only time I would hold into earnings is if I've gotten a double or more on half. So that way, when you're locking in the free trade before earnings, you can free roll, and sometimes it works like Microsoft. Other times with BABA, we only got a 25% gain on the total position because the second half did not work, and we shut it down today, soon after the open. So the bottom line is, you've got to know when to hold them. You've got to know when to fold them. Sorry, Kenny Rogers, but basically that's exactly what we're after. So Delta, these top and bottom ones, Delta shows you, okay, the stock goes up $1 in your favor. It'll tell you the percentage that option should go up. Most people would say, well, then you want to trade high delta so you're getting a fairly quick bang for your buck. That's true for conservative to kind of medium risk trades. But for more aggressive trades, actually, I would like to have a little bit of a delta that could go up quickly on a few points move in your favor. So it's not the first point you're thinking about when we talk about this gamma effect. Gamma is actually projecting what delta will be on the second point move. So the first delta, let's say that you start at 50, and you say, okay, the stock's at 100, it goes to 101. Your option just went up 50% of that. It went up 50 cents on that first dollar move. And you think, well, why would I buy the option? Because you're paying, say, 1% or 2% of the cost of the stock. You're getting huge leverage on that. But if on the next point move, it's now gone where you said, okay, at 100, we had a 50 delta. We were at the money. At 101, say we're at a 60 delta on these options now. Well, then what that means is that your gamma would have projected that you would pick up 10 deltas on the next move from 101 to 102. So as that move goes from out of the money to in the money in your favor, it's going to get more and more dramatic, and that's what you're going to benefit from with this strategy. So, for example, with this one here, ran gold when we got the signal, and remember, all three have to line up. So just because it looks like %R and the big trends bands are starting to go here, you can see that CCI was not there, and it still was not confirmed, even though it's trying to break out here. It couldn't get through that resistance. The next time when all three were ready to go was right in here. Okay, now you're getting all three ready to go, and boom, we're buying in right before that launch phase. 2 days later, it's not just a double in the first half, it's 160%. If I get a windfall above 100 on a gap up, still sell half of the position and just take more than a double in that case. That guarantees you a win in that case, even if the other half, half in this case, crapped out. It didn't crap out. It went to plus 200 a few days after that, and plus 300% on the 8th day into the trade. Now you can see it turned out that the 8th day in at the 300 was the peak for the stock. Sometimes that happens, sometimes it doesn't. I don't claim to be able to pick when these things are going to top. I just know that it's about gradually making money as the market makes money available to you. You don't want to be too quick with it. You don't want to be too slow with it. You know, I come from here, Kentucky, and horse farm country, as well as my family's raised a variety of crops over the years, so that farming mentality makes me think about basically you plant the seeds when it's just getting going here, and then you start harvesting gradually as your profits start to bloom. Okay, so now when you talk about the sweet spot of where we want to trade, most people would look at this chart of time decay, the theta chart of all the time premium in an option out, say 120 days, and they'd say, well, clearly 120 days to 90 days, you got your lowest amount of decay, so wouldn't you want to buy those? The problem is when you buy that far out, you pay a lot more time premium, so your leverage really gets cut down. My experience is somewhere in this neighborhood of about 40 down to 30 days, is somewhere in here, even down to as little as maybe 21 days, maybe 3 weeks before expiration. That's about as short term as I would go. If I'm 2 weeks before expiration, I will be out of the trade no matter what. So we've got a rule the first Friday of every month, which, you know, if we had any other February positions on, which we don't, but basically we would be out as of tomorrow's close, tomorrow being the first Friday's close, because there's 2 more weeks to go to the February options. We're mainly focused on the month out or so options here, but we're just going to give ourselves on a trade initially the first 5 trading days to give that trade a chance to start working. If that stock is flat or against us after the 5th trading day, if it's a small loss, a medium loss, or a bigger loss, we just say, forget it, we're out, moving on. Obviously, we hope that instead it's gone for us, we've been able to double half. One thing we don't do is we don't put price stops on an option that we buy as a cheap option in the first 5 days, because you'll get whipsawed so many times. You'll see stocks hit a 50% or an option hit a 50% loss on you, and then turn around and be a double or more. You know, so our experience is give it a chance in the first 5 days, and by buying a month or so out, you're not getting killed by that little bit of time erosion. You don't want to be in that 2 weeks or less range. Another chart of gamma shows you the most extreme example of gamma would be an option that's on its final day of its life. You can see here, if you bought an option, a 50 call right at the strike price at 50 on the morning of an expiration of an option, you would have a massive gamma. What does that mean? It means that if it goes from 50 to 51, the first delta is probably going to be a 50% delta. You'll make half of that 1 point move. But the next point from 51 to 52, with a gamma of 43, can anybody guess what would our next delta be with the stock at 51, a point in the money on the last day of expiration? It went from a 50 delta to what? It would go in a positive way. It would go to a 93 or 94 delta. So that's right, Rick. So basically, you'd be nearly 1-to-1 with the stock at that point because you have so little time left and it's trading in at near intrinsic value of the stock. So then you've gone into a tremendous leverage situation. You can see, though, going 60 days out, the slightly out-of-the-money options have the peak gamma. So about 30 to 45 days is still somewhat out of the money, going to be our best bet. I showed you Microsoft before. As we said, we're long out of it. But I was telling people at the time, we took half profits on it at a double, and we were going to ride the rest in the earnings. And I put myself on the line for it. I told people that about BABA recently in a public web event beforehand. I said, we've already doubled BABA. We're still holding the rest. I'm not telling you to buy BABA at that point. I was just saying this is what we're doing. And, certainly I wouldn't want people to be putting risk capital at work right in front of earnings. When BABA tanked down, we sold it out soon after the open and went ahead and just locked down a net 25% gain on the whole trade. Now, as I mentioned, BABA, but basically the kind of stocks that we like to trade for grand sum options, these are not just because we like to trade them, it's because they test well with this system. Most of these are either tech or growth names, or even like a Goldman Sachs, that they're high dollar names that can move quickly, a MasterCard or a Visa. Those are cash cows. They're taking a piece out of everybody's hide every time somebody makes a sale on a credit card and makes a purchase. That basically they're taking a chunk out of everybody's hide. So it's good for them, and those are good stocks to trade, particularly on the long side, the bull side. Microsoft been very good to us. On the gold side, Randgold's been our favorite gold stock. Schlumberger been probably our favorite oil stock. As I mentioned, Starbucks we were in, but we got out right before the earnings because it was only up 50%. Good thing we did. The stock tanked back off. Tesla, I've got a Tesla chart here next. Wynn Resorts is on there. It's been up and then back down pretty quickly here lately. It's been all over the place. But bottom line is that, you'll see examples like here with Tesla. This first one that was setting up here was not broken out yet on %R. We hadn't gotten the confirmation. When it did confirm here, it had already gapped way up. So we said at that point you have to wait and buy the next what we call retest, which is right there. Now that buy right there in mid-April last year looks like a pretty good spot, right? It's going up. But the problem is with Tesla is that you have to buy so far out of the money that it needed to go up faster than that. It didn't happen. By the time that the first Friday in May rolled around 2 weeks before expiration, you see you're flat from you're getting crushed on the option. That one was a total loss. Now, if you said, okay, I'm not going to trade Tesla again because that last one crapped out on me, you can see the next time that everything starts to actually set up here on this bar, and then it closes above it, the very next bar. If you don't buy that and take advantage of this 100, 200, and 300% window over the next week and a half, then you're shooting yourself in the foot. You can't be reactive to ones that work and ones that don't. What about this buy you say that didn't work over here? Well, you can see, in fact, CCI, that's just set up as a potential buy on %R, but even the ADX was still going down in green on the bottom panel. So just one of the three was working there. Prefer not to even see that, but sometimes our system will say, hey, you should look at this, and then we give it that extra, make sure that everything's all systems go. You can see with Schlumberger on the downside remember energy lagged for most of the year last year until the last couple of months. In September, I said it was my favorite value sector was energy. Expected it with the hurricanes to do really well, and it did ultimately, but it took a while. So timing's everything. We waited on Schlumberger until the beginning of this year before we got into a bull trade, and it worked really quickly. But you can see we had the first breakdown here off of this going oversold. So the %R is there first. CCI is right behind it, and then the ADX here takes a couple more days to kick in and confirm. All three are now confirmed, and we catch just in this quick little drop over the next week, 100 and 200%. I think the last piece went out at like 67 or 70%. So basically, it's one of those things where sometimes you won't get in a strong trend that 300% win, and that happens sometimes. But again, we wouldn't take this trade over here because it's not even there on %R. The only place it's there is on the ADX. CCI is not even there. Next time CCI sets up, it never closes through those highs, so you never take that trade, even later. And we like it to signal real quickly to keep us out of trouble. So the faster it signals, the better. It should signal within 5 days or less after we get the setup points. Now, what's interesting to me is that a lot of people that trade options have no idea what this concept of option charts is all about. Option charts basically means that you've got a very different look at how an option is priced compared to a stock. We all know this intuitively, right? But I've even had options strategists and true experts tell me, it's just a derivative of the stock. Why are you bothering looking at an option chart? Well, I had two big factors. Time. We know that if you buy Apple stock, it's probably going to outlast you and me on this earth. It'll probably be around for a long time with all the cash they've got, right? If you buy Apple 1 month calls, you've got 30 days to see that thing play out. If you're wrong, you can lose what you put in it, even though Apple's going to be around, the option isn't. So you've got this window of time decay and the finite assets that you've got to make up for, and also the volatility. If it's too volatile on that stock, you're going to pay way up for that option. Most of what I'm showing you here are not really volatility trades, they're trend trades. The trend overcomes the loss of time. If the stock stays flat, you buy an option, you're toast. That's why most people have shifted to selling premium, and they're making small little increments the majority of the time, and then they blow themselves up the minority of the time that it doesn't work. They don't know how to get out, and they end up not making any money on a premium selling approach. So what we do is say, look, take advantage of this low volatility environment as long as it lasts. I think it's in a bull market, it should keep lasting for quite a while, even though we'll get little brief VIX spikes. This is the case with Goldman calls. We got the quick double in 4 days, and then we actually trailed it to break even and hit the break even trail on the 7th day. Now in this case, up 100 in the first half, break even the second means you made 50% on the total position. You know, like I said, even on BABA, only 25% today on the final position close out against our first half double. What's cool about this is look at Goldman Sachs on an intraday chart. I didn't have enough data on the daily chart, so I looked at the intraday, and you'll see the same patterns on an intraday chart even. Here's a 30-minute chart, %R staying over bot. We have one retest right in there that holds. You can see the CCI and %R both come down here in that little gap down at about 160. We gave it room to a buck, but you can see if I was using the intraday chart, you could make a case that you shouldn't be in anymore below 160, in this case around 140. But, you know, bottom line is that where was it rolling? It was rolling from the buck to turned out to go to 240. I could never tell you the exact peak of any move or the exact bottom of any move. I'm more trying to catch what I call the sweet spot of the middle of the trend is the much easier and more consistent piece to trade than the end of the trend. Now, I talked about Microsoft earlier in the stock and this gap that we mentioned from 79 to 84.3. Look at the option chart on Microsoft. The Microsoft November 80 calls we bought, when we bought them there at 55 cents, you can see that, you know, technically %R was just starting to get going and then confirming about the time we sold our first half of our position at a double. Why would we do that? Well, because I told you at the beginning, if I get a double on something, I don't care how good the chart looks, I'm going to sell half of it and take my risk capital off, and then I've now not just financially freed myself, I have emotionally freed myself to give that rest of that trend a chance to run and turn into a true grand slam home run. So in this case, you see we keep going, but we don't get past about $1.50. We needed to get up to like $1.60. What was it? About $1.65 was our next target. Only got to like $1.50. And then I said, don't worry, just hold it. And then there's the open, 471. Thanks very much, 756 on that one. Now, you know, some of these are quick ones. Like this is Broadcom. Right about the time that all the news hit about Qualcomm and a potential takeover. Here's a case where we don't use stops because we got in right at the top of that circle bar, right off the open. You said, gee, your timing wasn't very good. It dropped for a day and a half. That can happen. You can see it's retesting. There was our retest of it. It closed below that %R level. That would have been an exit. You see that next morning, you know how tech stocks can be. They can be wildly volatile in a given day. Anybody that's not prepared for that is going to definitely get whipsawed all over the place. So our solution to that is let's not put a trailing stop in there. It was down about 50% at the worst levels a day and a half later, right? But then it was doubling up on this case on the 4th day, and then the rest trailed at the end there on the, technically I guess that was the 5th day on that final trail. Okay, so you know, up at a double, then a break even, 50% average I should say on that. Now what about on the downside? T-Mobile. T-Mobile had just broken down. Everything had gotten confirmed as of this close, so we got in on the next open when it gapped up on that Friday morning when there was hope that their Sprint deal might be on and get a lot of hype. And I look at the chart and say, it sure doesn't look like it's on. It looks like people are unloading this thing, and we want to be on it. We recommended the 57.5 puts that could not get filled at $1, so in an hour or so we changed it and bought the 55 puts instead at $70 a contract. Stock, as you can see, is trading around $59. So $70 to control a stock trading around $5,900 worth of stock value, right? So not quite 100 to 1, more in the 80 to 1 range plus. The next day, and I walked in on Monday, the deal's off, the stock's popping down to $55. We sell half at a double, and then the rest we are not holding. We sold it out a couple days after this chart, actually, for an average of about a 75% gain on the total trade. Southwest Air, again, another one we're already out of because, again, I hadn't had a chance to update a few of these last pieces. But you can see, here's the case I was talking about before. There's our setup on that first surge out of the big trends band combined with the CCI combined with the ADX upturn. It's got to close above that high, which happens at the next bar, and we wait. And then what we do is we send you the alerts out before the open on the next morning just to make sure nothing wacky's happening and we can get the proper pricing. Just pulling back a little bit, we buy them at 70 cents about out to January. So in this case, we actually have like 6 weeks to go before expiration. 100% 5 days later, 200% 11 days later. It turned out with Southwest, we sold the last piece at 300% December 21st at the exact peak in the stock before it came cratering back down. So Best Buy, we thought we could get to that 300. It rolled over on us on that last piece. This last piece did not keep going. It stopped us at 118%. On the last piece. Only got that, right? It took a little longer. That took about a full month, okay? We had bought January options, and we said, okay, look, we're just about to come into that exit there as of the first Friday in January, and it stopped us out right before that. Mylan, another one. We got our target of 300% on the last morning that we would have been closing the trade out later that day on January the 5th. So we bought them for, when the stock was trading here just over 40, like 40 and a half, we bought 2 points out of the money. About 5% out of the money in this case only cost us $62 a contract. The stock, you can see, you would think if it's trading that cheaply, the market's saying this thing really shouldn't go much past $43. Well, there's 43 right about in here. You can see it actually, in this time to the January expiration, I think it got to the 46.5 range or so. We were out at the 300% gain on the final piece. So we could go on and on about these examples. In fact, if you were looking at just our performance in January, I think it's kind of useful to break it down just to give you a taste. As I said, BABA is now closed. We closed the second half today. This was from my weekly video that I do every Monday evening. We send out a video analysis of all of our trades from the past week, open, win, loser, draw kind of analysis. And I said with BABA, look, we got our double there on the 29th a few days ago, and we're free rolling into the earnings. We're going to see what happens. The options opened down around 40 cents. They traded to 26 cents. We cashed them out at 50 cents intraday. So that second half lost 50%. We made 100 on the first. That means the overall position made 25%. You know, we did have a loser there on Rand Gold. You know, if you like to nitpick, sure, go ahead, nitpick. If you're gonna nitpick with these kind of results we've been able to generate, I say you're probably better off somewhere else, because this has been truly some kind of like my life's work, if you will. You know, this has been a long time in the making, and now we really feel like we've got it humming. No guarantees on the next trade or any future trades. We actually have a couple trades that we're going to be working for tomorrow morning. So if you sign up, you can actually take advantage of those. But the bottom line is that know that there's risk with this. Know that you could lose what you put into a trade. You could lose what you put into multiple trades back to back. You know, so that can happen, but what I tell people is, look, we're going to be actively managing to try to keep that risk down, and also to try to, more importantly, make sure we get you even bigger upside compared to what you're risking. So you can lose 100, you can make 100, 200, 300, sometimes more on a nice gap. So I think we do a lot of things uniquely at Big Trends. And what we've done here is we set up this page for you at bigtrends.com/GSO. Got a couple of charts I want to show you, and then I'll try to wrap it up in the next 5 minutes. But basically, you know, it's a tight focus list. It's less than 50 stocks right now that we look at to really say these are tailor-made for this kind of approach. The option charts give me a huge edge. I'm still amazed. I've been talking about them for almost, when did I start talking about 2001, I think I started telling people, look at the money we're making on the downside, looking at put option charts. When stocks are going down, the put option charts are going up. They're going up enough, they're like, whoa, we're breaking out on puts. That means you got a significant breakdown in the stock. Well, here's one on the upside on Cummins CMI. Not a household name, right? But bottom line is that when the stock's trading here about 177.5, we're buying 182.5 calls. In this case, these were a little close to expiration compared to what I usually do. This was right before Christmas. And then we said, look, we've only got about 2 weeks to let these things run. We can see in the first 5 days, 6 days actually, we got our double. So when we got our double, and then we put kind of some trailing stop rules, it got up to about 150, 160% gain, and then we trailed it and then got out of the second piece at 57%. So the average there is about what, 78%. So the point of this is that, you know, there's windows of opportunity here, and the big thing is that you just got to know what you're looking for and be particularly selective, or utilize a service like Grand Slam Options to help you find those next big moves in relatively short order. So the catalyst has to be there, whether it's an earnings surprise, whether it's a lot of these can be technical breakouts and everything kind of finally lining up. Buying the out-of-the-money options, we will never pay more than $100 per contract. That's $1 the way it's quoted. $100 to control 100 shares. If the thing's quoted at 110, I'm not going to stretch. I'll actually change my strikes and end up buying a 50 or 60 cent option instead of a $1 option. If I can't get them at $1, I'll go look at a different strike price. You're going to get high gamma with this, and it's definitely going to give you that more leverage. The time stop concept has saved us from countless whipsaws. I don't know about you, but if there's the thing that I like the least about trading, I love trading. Obviously, I've been doing it coming up on 3 decades full. But bottom line is that, you know, what I don't like about trading is when I'm right about something, but I get whipsawed out at a loss or a small gain or whatever, and then it goes on to a big gain. That drives me batty. So the answer to that for me is get rid of the price stop and keep a 5-day time stop. After the 5th trading day, if it's stock's down or even flat, we say bye-bye and get rid of it. If it's working for us, though, even if the option hasn't started performing yet, we'll keep giving it a chance because it says we're on the right side of where the stock wants to go. We like to book those windfall games, plus 100 on half, 200 on another quarter, 300 on the rest. And like I said before, the way that you can mess this up is you get greedy. From my perspective, that's what I'm trying to manage my existing subscribers who have had such success and saying, okay, you cannot start loading the boat. You cannot start taking out a mortgage on your house. That would be insane. You've got to just use pure risk capital that you know you could afford to take a drawdown and stick with the program. That's the big thing that I try to always reiterate to people, because there will be dips, and we do the weekly video training to tell you what we're after. I mentioned Schlumberger at the start of the year. This one was months in the making. You see how long the stock was stuck at the resistance? Our setup actually happened here right before Christmas. Percentar gave a setup right there. CCI came in a couple days later. Both of those levels you can see here were about $68, 68 and a quarter, something like that. The ADX is starting to turn up. This is off of a Thinkorswim chart, so you can do this on multiple platforms. But you see, the first trading day of the new year, January 2nd, we closed above that level finally. We're in there buying that next morning right in here. We're getting in right in this little retracement off the open for $1 on a 72.5 call when the stock's just under 70. And you can see 100, 200, and 300% in 4 days. That was like, we had 280, we got 300, maybe on the 5th day, I should say, 300 on the 5th. Because it just kept going. It went a little bit more than even where we sold out that last piece. I don't care. I'm happy to say thanks very much. As you see, the results speak for themselves. We know that past performance doesn't guarantee future results. I'm telling people to expect a drawdown along the way, but if you can just basically see the potential of how big these can move for you against the ones that move against you, you can truly take advantage of this. And Lou asks, yes, we always tell you when to get out. We never tell you, we never leave you hanging. We always tell you this is a spot we will get in. We send a real-time email and a real-time text if you want to get that to your smartphone. Most people do. It's all part of the service value that you're going to see here in a second. And what I did, you know, if you came in late, this is just our 13-month, month-by-month results. Gross profits and losses all added up before commission. So over the course of a year, or in this case 13 months, we would probably have done just over 100 trades, maybe 110 trades. You can take your commissions out accordingly. If you pay too much for commissions, you can check with Chris there, call us. We can get you some guidelines on good options brokers that can not only get you fair commission rates, but can also help you get in and out of these trades automatically. That's called auto trading. Don't have time to cover that. I'm over my allotted time here, so I need to kind of share with you what I'm going to do for you. Usually, you know, my subscribers have been easily paying a couple $1,000 as my best special on a 12-month access, you know, and 3-month access people have been paying $649. I'm going to do even better for you with this offer here tonight. I'm going to say, you know what, I'm going to let you try it for a month at half off of the normal $399 monthly. I'm just going to charge you $199 to try it for 30 days. And if you like it, you're going to just let it keep auto billing. If you don't like it, tell us in the first 30 days, and basically you won't have to have any more commitment. So what I want to do is I want to show you that page real quick. When you go to bigtrends.com/GSO, if I can find where I put that here. Here it is. You go to that page, and this is what it'll look like on this very special offer for the Candlestick Trading Forum, Steve Bigelow's group here tonight. What I did is I said, okay, you know what? If you buy a month, it's usually $399. You can see the months we've been generating, you know, 3,000, 4,000, 7,000 in January. You know, $199 will look like the investment of a lifetime if I can duplicate what I did in the past month or two. You know, so bottom line is, even if I do a part of that, I think you're going to be real happy. But what I'm doing is I am giving you half off here, taking $200 off by using coupon code GSO. That's a letter O, capital O, 200. So GSO 200 off is a way to think of this. GSO stands for Grand Slam Options. So the first three letters, then the 200. When you hit the Add to Cart button, by the way, down below you see the many examples of various names that we've hit. 100, 200, 300, and get a feel for, you know, some of the portfolio that way too. Not to mention the knowledge I'm going to get you. You'll get all the settings as a subscriber too, so you know how I'm trading it. Even when you do this 1 month offer, you're going to just get some phenomenal value here. Okay, so basically, let me show you. When you add to cart, all you have to do is go in here and type in this coupon code on the first little box there on the top left. GSO 200. I haven't actually done this on this computer, so it should work. There you go. Your coupon's been applied. So it took it from $3.99 on this 30-day monthly convenience auto renew, and it basically took it down to $1.99. You know, even when you're making much bigger returns than that, I'm still going to honor that $1.99 price in 30 days, in 60 days, in 90 days for those who take advantage of this here on this very limited time special. So the bottom line is you got to take advantage of this quickly, and then the price is going to go back up if you don't. So all you do when you set that in, and there's no shipping charge. You're getting instant access to everything. I'm only doing this for the first 50 people because, frankly, you know, we've had a ton of people that are just basically trading a lot in Grand Slam. So I have to make sure that I don't get too many people in the service at once, but I can take 50 more before I'm going to have to shut this down. But bottom line is that you got to act quickly if you're going to be part of that, especially at that kind of great pricing. I'm not making you pay $2,000 for a year. I'm not making you pay $649 for a quarter. I'm giving you actually a better value than even that at $199 every 30 days. You just hit the green checkout button when you're ready to go, and then you just get the information on our secure page at that point, HTTPS, and then the bottom line is that, and we don't store any credit card information. We do everything through one shopping cart, which is a very renowned credit card processor. Bold, you can see you've got all your key information there. We confirm your email twice. I want to show you something special here we do also. I want to show you that when you get your credit card information in, you get all that, and then basically you can, if Chris Sayre, who's been helping with comments, if he's helped you tonight, give him credit. You can put me in there. You can say you saw it on a webinar. But I want to point this out before we get to the final action of agreeing to the terms. I want to say, you know what, in the customer note field, if you want to get the text alerts, no additional charge. You're going to just pay the same rate. You just got to make sure you have unlimited texting on your smartphone plan. Most people do these days. Text alerts to whatever your number is. 1, 2, 3, 4, 5, 6, 7, 8, 9, 0, or whatever that number is, and then tell us which provider you use. If it's AT&T, if it's Verizon, if it's Sprint, I don't care. But basically, what I do care about is that every one of those we put on a different batch list for those dedicated programs. So if one thing gets hung up, it can't hang up. The rest of the things get going out. Everything goes out at the same time. We hit the button to everybody, and then basically, if we got an error report on somebody didn't get their text or their email, we'll resend it to you as we can. Or you can always call us too if you have any questions on that. But we've had a lot of success having the text alerts to your smartphone as what was initially a backup to the real-time emails. Now a lot of people actually prefer to get it on their smartphone first because they know that's how you're going to see it first and foremost. What I do ask you to do before you get signed up is review my terms and conditions. I'm really all about 100% transparency. Like I said, launched Big Trends in '99, so here we are. Just had our 18th year celebration there back in November, and you can see now very excited about what our 19th year holds for our Grand Slam folks as well as all of our Big Trend subscribers. Review those terms and conditions, and this is an auto renewal program, so it's important that you go ahead and make sure you're aware of the fact that if you don't tell us to cancel in the first 30 days, then yes, it will auto bill 30 days from now for the next month. So if you're not happy with it, we give you clear instructions how you can say, it's not for me, I'm out. Right now we've got everybody flocking to get in, so I'm pretty confident that we keep up anywhere near the level of quality that we've been giving in trades, and I think you're going to be real happy. Once you've reviewed that, hit the that you agree to the terms and conditions when you're ready to order, and then hit the submit order button in green right below the price, and boom, it should say, okay, you're good to go. If you have a credit card problem or something else that you might have typed in wrong, something that doesn't match on your address or whatever, you can just call us at our toll-free 800 number. On the order page at bigtrends.com/GSO, it's 1-800-244-8736, but remember, the easy way to remember it, it's just 1-800-BIG-TRENDS. Pat says, can you do this with a smaller account? You can. It's just that you're going to be wanting to trade a smaller amount per trade than what I'm showing here. So on a smaller account, just throttle your expectations accordingly. But even if you were trading, say, $400 a trade, that would still get you at least 4 contracts. In this methodology, that's what I recommend, that you should at least get 4 contracts. That would never cost you more than $400 in any one trade, and then you can diversify accordingly. So yes, you can do that and still do it with a smaller account. Auto brokers, Chris is putting those in there on the chat box. Let's see, going back, I'm sure I missed some questions as well. We do not do any compounding in those results. Those results are assuming that we just stuck with a flat $1,000 maximum per trade. If we compound the results, they would be, just so off the charts that, nobody would believe it, much less that I wouldn't want people to be trading that way, because that will always, if you keep compounding your profits, that will always set you up for taking your biggest losses right off of your last peak. And so I'd rather see you just stay slow and stable and keep you real happy rather than creating a more volatile experience in what's already obviously a pretty aggressive strategy. Mike says, can we provide you guidance on how to trade, set up your automated trade entry with target stops on Thinkorswim? Thinkorswim is one of our auto brokers, so basically that's something that they can actually take what we send. You give them approval. They confirm with us you're a paid subscriber to Grand Slam Options, and then boom, you just say, okay, you're good to go to trade X dollars that you told them you want to trade on each new Grand Slam Options trade as it comes in. And then when we say to get out, they follow the same instructions, and they're very quick at getting in and out. So we really do recommend that for people if they want the speediest execution. You kind of take yourself out as a middleman and let them do the work. You get the benefits. Trying to make sure I didn't miss any other questions. I know I'm a little over on my time. Thank you, Steve, and Becky and Jim, everybody, for taking a few more minutes with me. You're far too kind. But yes, you can do this in some retirement accounts with some options brokers. You need to check with your options broker and see if they allow it or not, because some do, some don't. So that's just kind of one of those. It's just no sort of legal requirement. It's more just what they're comfortable with or not comfortable with. But this is as simple as it gets, folks. This is straight option buying. I'm doing no spreads, no combination legs. I'm not trying to get cute. I'm just saying I'm either right or I'm not. And you know what? When, like I showed you, if you came in right at the end here, I was sharing with you. The bottom line is that we've had some tremendous success the last couple of months, and bottom line is we want to make sure that people are able to take advantage of what I think is a true mispricing in the options pricing market right now, which is that they're saying there's low volatility, but yet there's big trend. So when you have big trend with not paying much for it, and the fact that these trends that keep going to the upside in particular, you can really get some dramatic leverage against what those options should be priced at quite a bit higher. So take advantage of this while it lasts. I think it's gonna last us for quite a while longer here, but this special is not going to last that much longer. So take advantage of it quickly before it goes away with that link at bigtrends.com/GSO for Grand Slam Options. If you have questions, look at the top right. You can call us toll-free at 800-BIG-TRENDS, or you can email us anytime through clientcare@bigtrends.com. Since I'm a little over, I'm going to say thank you and bid you good night and good trading tomorrow and throughout the month and year ahead. I know a lot of people are going to enjoy this service, as well as the learning experience you'll get with my weekly training videos. You'll get an inside look at exactly how I'm setting these trades up, what my settings are on each of the indicators, why I didn't make certain trades, why I made other trades, why I got in, and more importantly, why I got out. You'll learn all that with the weekly training that I give you. So it's not a black box. You can then follow along for all you home gamers, so you can make sure that you're definitely also taking advantage of it. Not just for what I call out. You could apply this to your own stocks, your own assessment of other securities as well as you learn this. But learn it first by following along with me month to month here. So check it out. It's a 30-day try it out, and if you like it, it'll auto-renew after 30 days. And I'll keep honoring that low price of just $199. If it's not for you or that's out of your price range, I'm sorry. Hey, bottom line is it takes a lot of energy, a lot of investment with me. I've got a staff of multiple others that are helping me follow this stuff. So basically, it's like, hey, you know, I can't do it for free. You know, I would if I could, but bottom line is that I have to, not just from the profits that I make on it, but also from the fact that, yes, I have to make sure that all of my people are supported for the hard work that they do too. So I think it's a steal at that price. Bottom line is that it's up to you now to go ahead and lock it down, take advantage of this one-time offer with the Bigelow Candlestick Trading Forum group. So thank you, Steve, and the entire Candlestick Trading Forum staff. You all do a phenomenal job helping educate traders. I'm glad to be a part of that. Wish you all good night and good trading. See you soon.
Thank